Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description.
We're getting a few questions in regards to hedging. So I know we've talked about this. Hedges only cost money. But until I can see that selling underneath the surface that is persistent, breadth starting to roll over, right now, sucker's been strong off of that intervention low. And we got 100 days until that trend line that I showed you broke. So we still have a little wobble. There's no question. But that doesn't mean it's shortable yet. I'm going to defer to you on this, but you also were talking about a Nomura piece that said we're getting closer to hedging. What's your thought on that? Because right now the market is in its summer storm season. The volatility, like you said, it doesn't have to go any lower and market can still move higher. So we don't really have that as a tell. I've got no pattern or selling or breadth destruction yet. little signs intraday, and maybe it'll work from the inside out, but it's not enough to get excited about. We've got Nvidia 172, but they've got earnings in a month, and who wants to mess with that? So tell me your thesis on hedging a portfolio. I know some people do hedge every single position. Client Tim, literally, he hedges every single position, but I'm asking for portfolio management, risk management. What's your take?
And that's where you can have a bit of a more of a blanket approach by beta weighting your portfolio. So you can kind of get all your positions into a platform that can beta weight, and then you take your whole mishmash of what's going on out there. And this is not a perfect science, but you can figure out, you can sort of benchmark it against whatever you think your sort of broadest theme is. It might just be S&P, it might be QQQ. And then you just say, well, look, this portfolio looks like a 0.9 beta to the S&P. And that's going to give you an indication of how much protection you need in the S&P. And so you're going to go out. And so, for example, here is, I don't think protections are very expensive, even though we've seen skew kind of get pushed down a little bit. We're seeing that upside calls. What's happening is, we did talk about this either last week or the week before, people are starting to buying that upside. So instead of maybe buying the market, they're buying upside to not have to commit fully to it, but just in case. It's pushing up that upside skew, so that call skew. So if anything, callers are kind of pricing not too badly right now, because you can sell those sort of more expensive calls and use that to finance some of the downside protection that you might want to own. But if you look at something like this, I think this is quite reasonable, especially if you're up money. The problem is, I think a lot of people kind of go, well, puts, it's like tossing money in the garbage. And a lot of the time it is, but it serves that purpose, kind of like your house insurance. You don't want to make that call and say, hey, listen, I got to exercise my puts on my house because my house burned down. So you don't really want to have to make that call, but it gives you that peace of mind that if something happens, one of your largest assets is indeed protected. And you should probably look at the market the same way. And a great way to really, in the S&P, for example, you have such steep downside skew. What that means is the way out of the money puts tend to be quite expensive versus the at the money, and certainly versus the calls. The call side is usually a terrible trade to sell, which is why buying them, we always talk about how the upside is cheap. I've always found over my decades of having done this, one of the greatest trades in the market is upside index calls, just long index calls, because they're usually underpriced. You don't just always buy them, but when the momentum's underway, that's when you get those climbing the wall of worry type markets, and that upside is too cheap. Like, look at the last couple months. I mean, the upside was cheap. We talked about it for about the last 700 points. If you look at this downside put spread, you can buy a December 590.25 put spread for 810. That is not bad. Look at that. You're spending 810, and you could turn this thing into, on a 10 lot, you're going to spend $8,100 and turn it into 57 grand. I mean, that's at expiry. So if the market goes down, you are going to be following this magenta line. The blue line is expiry, and that's certainly, the expiry line is valid. There will be advisors out there who are not in this to trade it. They're in this to protect the way that this position is meant to protect, which is, if the market closes in December under $500, I'm going to get the full value of this put spread, just like the JPM caller. They own a downside put spread. They're not trading it. They're not saying, oh, maybe I'm going to get out here because I'm calling a bottom. They're going to wait and see what happens. If you're more of the trader variety, you're going to be looking at this magenta line and say, okay, I may not get the full value of this, but at 500, I'm going to get, maybe like 2/3 of the value, maybe a little bit more. And also, you're going to do a little better because the volatility is going to explode. So notice that you're long a lot of Vega, which is going to get counteracted a little bit by this short Vega, short put down there. there. So that may counteract a bit of that effect, but you're going to make money. So this is where you can use some of this leverage. And if you look at the cost of this, let's say you own the SPY and you're up $250 on it for 5 months protection going into a very uncertain AI world and Trump world and all this stuff going on. $8 is not a lot to spend.
You did a great job talking about it, but show us the chart.
Then here's your put spread. You're spending $8. Look at this beautiful, beautiful P&L here. You're spending this to potentially make this. I think that's pretty good. You're going to protect yourself between $5.90 and $5.25. So you're going to get a full $65 of protection. And as I said, by selling, I mean, you don't have to sell that downside put, but you're going to get a little bit of value for it from that skew that I mentioned. Those downside puts are expensive. So, and for the most part, people are not betting on the end of the world. They're betting on, okay, it's going to be a healthy correction. We're going to go down 10, we're going to go 12%, 15%, whatever it is. And as I said, advisors like these kinds of structures because they are not looking for the end of the world, but they would love to be able to protect a portfolio to the tune of that amount. And that's putting leverage on your side, right? When you're selling if you were to sell this spread as an option income trader, you get the opposite of that. You're risking a whole bunch to just make a little bit. But from the protective perspective, this prices nicely, even though skews maybe not, I'd have to look at December. In the short term, skew has been flattened a little bit, but that's not bad. Out to December. This fall, anything can happen.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.